All right, class, welcome to week 4. I did want to make one comment about a lot of the discussion boards. One clarification for the LIFO-FIFO weighted average cost method is that when you're using these methods, you use those methods and create a different account for each item in your inventory. So the iPhone 9, the iPhone 10, a lot of y'all went with tech, apples, oranges, any of those that are all of the same inventory item, that will go under one classification. But the apples and oranges, you'll keep separate if they're different components. So with that in mind, I think that changes the mindset of kind of why you would use those systems and when. So, but going back to the tech for the iPhone 9 and the iPhone 10, even though the completed components are a separate item, the actual parts that go into building that, a lot of those will be the same. So your 32 gig memories, the different chips here and there, all of the components that might be the same, each of those components are going to be accounted for separately. And those in technology are the ones that tend to decrease over time. Because think about it, the memory space today is going to be a lot cheaper than what it cost to build 3 months ago, 6 months ago, whichever. So that is why the technology industry tends to shift the way they do their reporting, because it's as they continue to buy the same inventory, those items are going to become more obsolete, and therefore the price is decreasing when they buy them, because they're still going to have iPhone 9s with an 8 gig memory, even though another one's going to come out with 200 gigs at this point. So I just wanted that clarification in hopes that kind of clears up what you're thinking. So on to week 4. This week you have one chapter. It's on chapter 8. Then here you have the reading, you have the presentations, just like each week. For the assessments, you have another discussion board. You can do Thursday for the initial post. Please respond to 2 of your classmates' posts by Sunday. You'll have the Learn Smart assignment, the homework core, which we'll get into. And this week, we are officially halfway through this semester. So with that in mind, you have the midterm exam. Please make sure you finish by midnight on the 7th. If you have any issues getting with that, let me know. I've gone through it. If you go through each of the homework assignments, you shouldn't have much difficulty as long as you remember how to go through each of the calculations and you study with those flashcards. So it should be good to go. So this week, it's 2 main issues. We're talking about internal control and we're talking about bank reconciliations. So internal controls, we've talked about Sarbanes-Oxley for a little bit and the impact of that. And so one of the impacts of that was that each publicly held company had to go through and actually fill out what they call the COSO framework of internal controls, and the senior management had to sign off to say that the public company went through this assessment and that they're confident in the internal controls that they present. We won't go through in detail what this framework entails, but I wanted you to see this picture to feel that there's more than one type of control, there's more than one risk, and the complete assessment is needed looking at each of these factors. So the internal environment will obviously be, how is your people set up? What's your code of conduct? What type of policies do you have in place regarding your harassment? Each of those type of items. And then it goes all the way down through here. So again, that should help kind of going through, we'll go through some of the assignments on that. Bank reconciliations. I would go ahead and start making a flashcard. We will fill this template out when we get to one of the assignments. But this is the goal of the bank reconciliation is to make sure that our accounting records match that of what our bank statement is, so that we're supporting that. However, there's always going to be timing differences because some items we won't know about the bank until the very last day when we get the statement. Now, a lot of this is going under the assumption that we're 20 years ago when we didn't have online banking, we were beholden to the statement that came in at the end of the month. The accountants would have to do a full detail of this at the end of the month to compare what our accounting records were to that bank statement because we didn't have the instant ability to go in and check the bank. That being said, we're still going to use this template. We're just going to do this daily now. And we're going to walk through which transactions did we record, which transactions did the bank record. You might be surprised the bank does make errors from here or there, especially with dealing with multi-million currencies, the like. So we'll go through what will show up on a bank statement that is the first time the accountants will see that and therefore we'll have to book it, or what the bank might not have yet if we send out checks or if we know the deposits are coming, things like that. After we do the reconciliation, you'll see here, so the bank is one balance, book is another, but the ending balance has to be the same. And then it's not enough to just reconcile it. We need to get our book balance to match because remember, right now we're here and we're saying that this is the correct reported balance. So our job is to go through there and then book anything on this side of the template. So I want you to make your flashcard and keep that in mind that when we do this reconciliation, we will have things and we'll mark what those things are as we go through. But everything on this side will then require a journal entry so that our book balance ends with this. At this time, I wanted to go ahead and speak about our personal finances. So if you're not in the habit of doing your own bank balance, everybody's at different stages. You might not have a bank at this point. Eventually you will. So I wanted to, now that you've kind of getting an idea of what an accounting is and what's the purpose, I wanted to actually show you how I use accounting in my own personal life to make my own budget, which does start out with a bank statement each week is when I go through here. A lot of components to it, but basically I have my own journal entries that get posted every month. From here, this pulls into a comparison sheet that does a budget to actuals and tells me my variance. I do want to retire at some point, so what I've done is set what my end goal is in savings, and then I've done a net present value back to today, and then I'm saying each year this is how much I have to create in savings, and if I do that, I'll be good. What is savings? So we've gone through, from a business perspective, assets equals liabilities minus equity. Well, in your own personal finance, the equity is what you have created. So that difference there, it would be what your savings are. So I have my own personal balance sheet. I go through this about once a week, knocking out what is, if it's an asset, it's a positive, if it's a credit, it's a negative. Once I've gone through that, I do a comparison to the month-on-month change. I make sure that each of those differences have been recorded in the transactions and are flowing through. And then I track, so this is how much I budget to spend each month. This is how much I actually spend, and I track my variance each time. And what it allows me to do is create pivots that say, this is how much I've spent on interest, this is how much I've spent on groceries, on each of these. So blacked out everything, but again, this is the goal of accounting, is that we know the transaction, we process it, we figure out how that impacts our operations, and then we give management advice on where to go next in terms of building that wealth. So when you're personal finance, that wealth is your own equity. In a business, that wealth is the equity of your shareholders, your partners, those that own the stock in the company. So with that in mind, let's get into our week 4 homework assignment. Okay. So again, we're analyzing internal controls. We're going to list out which control each of these scenarios violates. So scenario 1, we have a person recording all in-customer cash receipts for their employer and posting them to the customer payment. So anytime you see recording, so the posting and actually touching the money, that's a separation of duty. So as an accountant, we want to stay as far away from the actual cash as possible because our job is to record the transactions. And if we have the ability to touch the cash and record the cash, then we now have the opportunity to take that cash and either not record it or record it somewhere else. So with that, that's going to be a violation. So again, thinking of the fraud triangle, opportunity, motive, right there, that gives opportunity. At Tico Company, these people alternate lunch hours. Julia is the petty cash custodian, but if someone needs petty cash when she's at lunch, Trevor fills in the custodian. So again, that's establishing responsibility because at this point, we want to be able to hold someone accountable for the petty cash. And if both Julia and Trevor have access to the cash, then at any point if the cash comes up short, we don't know who is responsible. Okay, so again, trying to identify exactly what's happening at each point. So we have someone posting charges and payments, and each night they have a backup to the tape, and stores the tape in a locked file at their desk. So again, application of technological controls. So since she's the one that is in charge of the accounting system and the files, we don't want her being the one that's posting the information. So there's always a risk there if one person has more than one responsibility. And here with technological controls, it's the same thing. Hiring quality workers who require little supervision, gives employees full discretion, independent reviews. Okay, it doesn't matter how much any manager trusts his employees. At the end of the day, the manager is the one signing the reports, and there needs to be an independent review. There always needs to be one person that prepares, one person that approves. And that's because just not only a sense of wrong, but just as a double check. There's always going to be human error. The more human interaction with the process, the more likely that error is to occur. So it's always good to have someone check that. Doesn't mean they suspect it's going to be wrong, but they still need to make that check. Trust but verify. So manager told to reduce costs, then to raise the deductible from 5 to 10. This cuts the property insurance in half. In a related move, she decides that bonding is a waste of money. So again, it's just the person insuring the asset shouldn't be the one dealing with the employees. Right. So again, just the person that's in charge of insuring the assets should be different than the one that's bonding of the key employees. You can read more text there. All right, so we talked about petty cash. So we're doing what's called a petty cash reconciliation. So petty cash is one of those items where the cost of accounting doesn't necessarily match up with the benefits of the information. So yes, ideally, every time a transaction occurs, we would want to go into the ledger, book that transaction right. However, petty cash by definition is going to be immaterial to the overall point of the bank. So we still want to have it correct by the time we do a month-end report, but during the month, we're okay with it occurring outside of the ledger. But then at the end of the month, we're going to go through and make all of the transactions that we would. So to establish that fund, petty cash is an asset. So increase in asset, we debit. We're taking it out of our bank account, ideally. And so that's an asset that's being reduced. Again, this has no impact on the balance sheet as an asset increases and decreases. Once we go through, we won't make transactions during the actual time. But on the 15th, we realized that we were pretty close to out, if not out. And so we needed to write a check to come up. At that point, when you write that check, remember we have to keep our bank balanced. So at that point, we'll make the record. So we're reducing the cash. This is how much we've had to pay. And then at that point, each of the items that we spent the money on is going to be an expense, increasing, expenses debiting. As we go through here, so we paid 78 in janitorial services, 63 in miscellaneous, postage 43, advertising. Now when we go through here, there shouldn't have been anything left as we go when we do the math here. So we started it with 250. We then took out 78, 63, 68, 43, 50, and 57.15. So each time something happens in the petty cash, we will want to make a record of it. That's your receipts. So that way we know what these amounts are when they go through it. However, again, the more humans you have interacting with the situation, the more likely there is for error. So at the end of the day, we should have had 767. We counted and said that we had 1917. Okay. So if I went through and did this transaction, I would be debiting each of these, and I should be crediting cash for that same amount. But instead, I need to replenish the funds by the 230.83. See, I want to have the balance to be 250. I counted it, and there's 1917. So I'm writing a check for 283. So at that point, you can just fill out your journal. These are your debits. That's your credit. Your journal has to balance. So how do I do my debits here and my credits here to balance? Well, it's going to be the difference between these amounts, the 1150. Okay. So again, you can just go through and say, how much is this? This needs to equal the same. Okay. Then we decided, hey, we're going to just need more money in there overall. So again, we're going to increase petty cash, decrease cash, same debit and credit. All right, so now we're reporting that we had 318. So if we go back, we want to have 450. And these transactions are already recorded at this point. We've gone through and we've counted that we have 318.39. Okay. So that means something was spent, 131.16. We know here we have postage of 48.36. Mileage of 38.50. Delivery of 39.75. And at this point, if all we did was debit these and credit the cash 131.61, our entry would be short $5. Or another way, After the transactions, we should have had 323. We had 318, so $5 was short this time. So realize if you're over, it's a credit because you didn't spend as much as you thought. If you're under, it's a debit. You're increasing the expense because that drawer is short. Okay. All right, and yes, it is possible to decrease that fund if they went back and instead of spending the money, they go back and deposit that for 50. So this time we're increasing cash, decreasing petty cash. Now, one thing to point out, the reason that these are all hitting expense accounts is because that's what we purchased this for. If this is a small business and let's say they decided to pay their insurance for the year in cash, using their petty cash, that would still go to a prepaid account. They bought it for inventory, that would go to an inventory account and then be accounted for as the inventory is used. Supplies, anything like that, you will want to go to the account that it designated. So it doesn't have to go to an expense. But usually your petty cash is going to be for those smaller items that's not materially enough to be considered supplies or anything like that. So cash and cash equivalent, again, so on the balance sheet, you list out things in order of liquidity. Cash is the most liquid, so it's there at the top. There's cash, which is your bank accounts, any actual currency, anything that you can go anywhere and spend right at that moment. There's also cash equivalents where at any point I can go and there's a set value for this amount that anybody will purchase. However, it's not cash. And so we do want to break those up depending on what they are. So the US Treasury bill, money market funds, those are at any point, there's a market out there, quickly accessible, go to it, sell that, have the cash. But it's not cash right now. Can't go to the grocery store and pay with the US Treasury bill or pay with a AT&T stock, anything like that. And then again, any investments within 3 months of their due date. So when we talk about money market or any type of bonds or something, it's not going to be long-term investments that we're going to keep in cash and cash equivalent. If there's a plan to keep it for longer than 3 months, well, then it's not liquid. It needs to go into the short-term investments. But again, just think about, can I go to the grocery store and spend this money? I have a debit card, so I can take it out of my bank account. Not a credit card, that goes onto a liability. Voucher system. So the voucher system is your three-way match. So the three-way match is going to match the invoice, purchase order, and the voucher. What that means is the way that especially companies that heavily rely on inventory, they're going to want to have even more controls regarding those processes. So the voucher system, what it does is say, before we purchase and send money out the door, we need one to validate that, yes, the company approves for you to go out there and make this purchase. Then you have to be able to validate that this is a legitimate business that is selling you these goods. Then you have to say, we got these goods. All right, so that's your three-way match. Outstanding checks, not going to help. All right, so then it's time to fill out our bank reconciliation template. So as we go through these, again, this template's going to make it a lot easier to answer these questions. So make sure you make this into a flashcard. So we're not going to look at that for a second. So interest on a cash balance. Like I said, there are certain things that you're not going to know about until you see the bank statement. One of those is the interest. So the interest is on the bank statement, so it's here already, and it increases the value. We're going to add that here. Bank service charges, another thing we won't find until we see the bank statement. At this point, it's already on the bank. It reduces our cash value. We're going to need to put it here. All right, debit memos are, again, items that have been reduced, taken out of our bank balance. So what they're calling a debit memo, I know when you're talking about banks, the debit and credit gets backwards sometimes, but the debit memo is, think of a auto draft, if you set up your utility bills or your rent or anything like that on auto pay, you won't know about it until you see the bank statement. So that's what the bank calls a debit memo, is authorization to deduct that amount from your bank without you actually going and initiating it. So you're not going to see it until this point. You're going to have to reduce it. Outstanding checks. So we've already written it. Our book account has already taken it, and it's going to reduce our bank balance. We call those OSCs. Credit memos are the opposite of debit memos. And what that means is someone delivering funds to us without us depositing it. So think of if you have direct deposit from any of your working, goes there. NSF check. So this here might be a little bit different. So what this is we've deposited a check, and so we recorded it on our book that said we had this deposit. We increased our book balance because of this. The bank then tries to deposit that, and the person doesn't have the funds in that account, so they actually do not add it to your account, and it's no longer valid because that check's no good. So we've added it to our book balance, so now we have to take it. Outstanding deposits. So these are deposits in transit now. Again, most of the time these days, deposits are pretty quick, but sometimes there is still a day lag. But same thing with outstanding checks, outstanding deposits, you're going to add back. And again, at this point, anything in here, you need to record. Okay. So as we go through, anything on this side is your book. It's up here, it's an addition. Down here, it's a subtraction. And again, these are all of the items you need to make an entry for. Very good practice. All right, so just some true or false. The primary objective of internal controls procedures to grow the assets. That's why it's false. The goal is not to grow, it's to protect assets. Separation of recording of keeping. Likely increase. Now, if we keep record keeping separate from custody of the assets, that should decrease theft and fraud because you have one person recording it, one person maintaining it. Responsibility. So again, separating it will prevent. Yeah, that's the whole reason we have separation of responsibilities. So that's true. Separation of record keeping from assets. The custody will not prevent collusion. So again, no system will ever be perfect. A lot of y'all in week one wrote that thanks to SOX, thanks to the Dodd-Franks, that fraud is gone. I think it's a relevant note to date that although there are rules in place and there are guidelines and there are very strict protocols and procedures for accounting, these are people. People don't necessarily always follow those rules. Any rule that you come up with, they will have someone that finds a way to break it. Again, at one point, the estimate was about 90% of fraud goes unreported. It's hard to actually put statistics to that because, again, it's unreported. And a lot of times, even when companies catch it, they actually won't report it because of the damage that was caused by all of those. So that's why a lot of this isn't prosecuted. Instead, you'll have backcourt agreements, or the people will plead guilty or non-contest in exchange for recovering those funds. Because again, as soon as the crime is reported, all the assets of that person tend to get frozen, and so it's a lot harder to recover, which again will be the primary goal of a company. So because of that, it's very hard to be perfect. And with that in mind, in that system, if more than one person get together, it's going to erode a lot of those controls. So that's why we have separation of responsibilities. But if those two separate people get together, then it's going to be an ineffective control. So we have more petty cash, so I won't go through each one of these, but same thing, if we increase the petty cash, that's an asset to get it started. The only thing here is that you have two different scenarios. One where they just record the transaction straight up. Two is if they decide to record the transactions and increase the funds. And so the simple way is just record those as two separate things. First, replenish the funds back to where you were at the 190. And then add 50 to it. All right, so this one's a two-part going into it. You have the template now, so I won't go through each one of these, but as you go through, deposits in transit are going to be added back. Checks outstanding are going to be deducted. You're going to add back any of the debit memos. You're going to subtract out any NSF service charges. Now, an error is one thing that in this template could be on any side, because the question you have to ask when you come up with an error is which one of these recorded it correctly. If the book recorded it correctly, you're not going to make an entry on the book. You make an entry on the bank. Okay? And then you're going to only make the entry for the difference. Okay, so let's look at this one real quick. Right here, check number. Okay, so you had two checks that were outstanding, but they say, oh, here it is, sorry. Canceled checks on the bank statement found that check number 3056 was correctly drawn. So we wrote the check for 1220, and you see here it was correctly written and drawn. So the bank gave the right amount to our landlord. But when we recorded it in our records, it's for 1210. So that means the bank is right, the book is wrong. We actually should have wrote it for 1220 instead of 1210. So we're going to record the error there for 10. Now, at this point, we have the reconciliation. Remember, everything on this side now becomes an entry. Okay, so anything that adds to the cash, so you won't have any entries for anything on this side. And anything that added to the cash, we debit cash. Anything that subtracts cash, we credit cash. And you can see the offsets. We had to increase rent expense because of the error. We had a debit memo, so our cash was received. The reason that cash was received was to reduce the liability that was owed to us. The AR and notes receivable long term. And then we here, we're reducing the cash for the NSF. So here, the reason they paid us the cash is because they owed us the amount. So we had an accounts receivable. When we received that cash, that check, we credited AR, debited cash. Now we're saying that that check was wrong. So we have to reinstate the AR and reduce our cash. We had an expense for the bank fees and no interest. Okay. So here, repetition, I have another bank statement to do. Adding deposits in transit, deducting outstanding checks. Here we have an error. Question is, who's right, who's wrong? What is the impact of that? And then service charges. Okay. Petty cash again, increasing cash, decreasing cash. Each of these work through. We had here they tell you that we had a shortage, so any shortage is basically an expense. Expenses are increased by debiting. We'll walk through that. And that's it. So I hope you enjoyed this lesson, and I wish you the best during the midterms, and reach out if you have any questions. Thanks. I'll see y'all next week.